In this episode, we're going to touch upon some recent happenings both in India and on the global stage. First up, we'll dig into the highly anticipated Q1 GDP numbers. Now, with the world facing economic recession, we'll take a close look at how India's growth has fared in the first quarter of the current fiscal year. Next, we'll talk about some developments within the Brics organization and examine its relevance in today's context. And in our final segment, we'll discuss the reasons behind India's declining foreign direct investment flows. Now, does this dip indicate a loss of investor confidence in the Indian economy? We'll explore this question too. Let's begin. You're watching Informed Investor, an initiative by Research and Ranking. Before we dive into the Q1 numbers, let's understand how GDP is calculated. When we're looking at India's economic activity, GDP is the name of the game. There are two main methods used to calculate GDP. One is the production method, which takes into account the total output produced across various industries, and second is the expenditure method. The expenditure method focuses on the spending side of the equation. It breaks down GDP into four key components, each playing a crucial role in driving economic growth in the country. Now, we've got private consumption. That's the money spent by consumers like you and I, like buying cars, furniture, food, clothing, etc. Now, moving on, there's gross fixed capital formation or investments. This is also called I for short. Now, this covers spending by firms and government on things like machinery, equipment, etc. Then comes the G component, which is government consumption and investment. This includes the money spent by the central and state governments on various projects and services that benefit the public. The net exports component is about the international game. It's the difference between what a country exports and what it imports. In India's case, because we tend to import more than we export, this component often has a negative impact on GDP growth. So when you add all these elements together, you get the grand total of GDP. In simple terms, it is the sum of all the money spent on consumption, investments, government activities, and net exports within the borders of a country in a given year. Now, let's delve into the recent economic data and analyze the growth in India's GDP during the first quarter of fiscal year 24. In Q1, India's GDP grew by an impressive 7.8%, a significant improvement compared to the 6.1% growth in the previous quarter. Now, at first glance, this appears to be an impressive growth rate. However, it's crucial to understand that this growth was influenced by a favorable base effect. If we take a look at this chart depicting economic growth trends from 2021 onwards, we notice a consistent pattern of high growth during the April to June period or quarter one. Before the pandemic struck in quarter one fiscal year 20, the GDP stood at 35.6 trillion rupees. Now, this figure contracted by almost 24% in the April to June quarter of fiscal year 21, plummeting to 27.2 trillion rupees. Now, this was due to the pandemic-induced lockdown. Because of this, subsequent economic growth during quarter one has appeared relatively robust due to this low base figure. Now, let's break down the factors that contributed to this growth. Private consumption, which had been sluggish with a growth of only 2.8% in the previous quarter, picked up momentum in the most recent quarter, expanding by 6%. Now, this signals increased consumer spending, which is a positive sign for economic recovery. Additionally, investment activity maintained its healthy momentum by growing 8% in the quarter. Now, talking about the various sectors that contributed to the GDP growth. Agriculture grew by 3.5%, industry expanded by 5.5%, and within the industry sector, manufacturing saw a growth rate of 4.7%, the highest since quarter one of the previous year. The construction sector also experienced robust growth of 7.9%, primarily due to increased central and state government spending. However, the standout performer was the services sector, contributing significantly with a growth rate of 10.3% over the last 3 months. In conclusion, while the 7.8% GDP growth in quarter one appears impressive, it is important to recognize that the favorable base effect played a substantial role in making the growth rate seem larger than it would have under normal circumstances. Nevertheless, the positive trends in private consumption, investment activity, the strong performance of key sectors like services, manufacturing, construction indicate resilient economic recovery in the face of challenging global conditions. Now, looking ahead, there are indeed several factors that could impact India's economic growth in the coming quarters. The resurfacing of inflationary pressures in recent months is a concern. High inflation can erode consumers' purchasing power, leading to some moderation in consumption demand. This could have an effect on various sectors of the economy, including services. Additionally, the lack impact of monetary tightening measures undertaken by the RBI may further contribute to this moderation in demand. Now, weather-related factors such as monsoons can significantly affect agricultural production, which in turn can impact rural demand and overall economic growth. While government capital expenditure has played a pivotal role in supporting investment demand, the sustainability of this growth momentum will depend on a sustained pickup in private investment, which we see is somewhat lackluster right now. Now, India's economic growth is not isolated from global economic trends. Slowing external demand, especially from major trading partners, can impact India's export-oriented sectors as we are currently witnessing right now. Lastly, the effectiveness of government policies in taming inflationary pressures and supporting economic recovery will also be critical going forward. Now, looking at the broader picture, it is encouraging to note that India is expected to maintain a growth rate exceeding 6% for the fiscal year 24. Now, if this forecast holds, India will retain its position as one of the fastest growing major economies in the world. Now, let's dive into this exciting development regarding the Brics organization. Brics stands for Brazil, Russia, India, China, and South Africa. It's this group of nations aiming to boost economic cooperation amongst its members and ramp up their global economic and political influence. Last week, these Brics nations made history by doing something pretty significant. They decided to expand their club and invited 6 new countries to join the group. These newcomers are Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the UAE. Now, starting from the 1st of January in 2024, these 6 new members will officially become part of the Brics group. And this brings in a host of interesting developments. Let's discuss this. If you look at their combined GDP, it's going to be around 29.3% of the entire global GDP, which translates to roughly $30.7 trillion. Now, because these new members are developing economies, their inclusion isn't expected to contribute to a massive rise in the overall GDP. The Brics Club has always had some heavyweights when it comes to people power. India and China alone boast over a billion people each. Now, with the addition of these new members, the Brics alliance will have a staggering 46% of the world's population. But here's where it gets really interesting. We all know how crucial crude oil is and how countries in OPEC play a big role in managing its supply and prices. Well, despite the global push towards cleaner energy, the global oil market is still a pretty big deal. And with Saudi Arabia joining the Brics, a country with massive oil reserves, the total share of Brics in this arena jumps to an impressive 43.1%. Now, that could shake up the dynamics of worldwide oil trade, especially as we talk about reducing the dominance of the US dollar in oil transactions. And last but not least, let's talk trade. China is already the world's biggest exporter, holding a hefty 14.4% share. But when you throw in these 6 new countries, the Brics group's collective share in global exports grows from 20.2% to 25.1%. The Brics alliance has a multifaceted agenda. Its primary objectives are centered around promoting peace, security, development, economic cooperation on a global scale. At the same time, it's no secret that part of their agenda involves challenging the long-standing dominance of the United States and the Western allies on the world stage. If you take a moment to search for information about Brics, you'll find a range of opinions and perspectives. Some even go so far as to call it the potential next superpower. They see Brics as a competitor to the G7, a group of 7 advanced economies that has held significant influence for years. However, not everyone views Brics in such a positive light. Some critics label it as anti-democratic club, and they call the recent addition to Brics a wrong kind of expansion. Indeed, when you bring together countries as diverse as India and China, consensus on many issues can be elusive. While we may have our reservations about these viewpoints and opinions, the expansion of Brics does shed light on the group's ambition to carve out a distinct development path that isn't tied exclusively to the Western world. Now, breaking the established Western world order is no small feat, but the aspiration is undoubtedly there. However, achieving this will require a strong commitment to cooperation and collaboration among the member nations. Now, the key lies in their ability to find common ground and work together towards their shared goals. Capital is like the lifeblood for a country's economic growth, and most countries can't fulfill all their capital needs alone. So they look towards foreign investors for a helping hand. Now, there are two main ways these investors dive into another country's economy. One is foreign direct investment, the other is foreign portfolio investment. Foreign direct investments happens when a country from one country puts their money into business in another country. And they're usually in it for the long run, meaning having a real stake in the foreign economy. On the flip side, you've got foreign portfolio investments. These investors invest in things like stocks and bonds of companies in another country, but they're not really getting deeply involved. Now, most countries prefer FDI because it is much more stable. FPI, on the other hand, is a bit unpredictable. They call it hot money because they run at the first sign of trouble in an economy. Now, remember the Russia-Ukraine crisis when FPIs took out huge sums of money out of the Indian market. Now that we've broken down the types of foreign investors, let's talk about FDI in India. Since 1991, India decided to open its doors to more foreign direct investment. And let me tell you, it has paid off. India has been focused on making reforms to attract foreign investment. Now, no wonder it's been receiving significant FDI over the past decade, ranking among the top FDI recipients globally. Even when the pandemic hit, India didn't back down. In fact, it saw the highest ever influx of FDI, a staggering $81.97 billion during fiscal year 21, a 10% increase compared to the previous year. But sometimes, even the strongest stumble. FDI inflows in India have taken a hit. FDI equity inflows plummeted by 34% to $10.9 billion compared to the same period last year. India, a developing economy, requires FDI because it is a crucial catalyst for economic growth. FDI brings in not just money but also valuable intellectual resources, access to international management practices, skills and top-notch technology. Now, to hit that mark of being a 10 trillion economy, we've got to attract FDI, especially in those sectors that need a lot of capital and contribute to our overall economic growth. Now, you might wonder if this drop in FDI reflects a lack of faith in India's economy. Now, this dip in FDI isn't exactly breaking news. It's been a trend worldwide with uncertainties looming about a global recession. The dip in FDI equity coming into India is on the back of the global economic slowdown, affecting investor confidence in Europe and the USA, with multinational companies holding off on further investments. Now, we do expect that India will continue to see a rise in foreign investments once these headwinds stabilize. Steps taken towards lowering of corporate tax rates, streamlining labor codes, introducing reforms for ease of doing business, the massive capex spending, and initiatives such as Make in India have been very important for attracting foreign investments into the country. Now, despite the minor bump in our FDI journey, we're keeping the optimism alive. With all these strategies and policies in motion, we're confident that foreign investments is going to keep flowing into India. Having said that, this is me, Merlin Sadana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.